Shashank Khare from Kotak AMC. And Shashank, hi, your take on the budget and whether or not it did enough to start the growth engine of the economy.
No, I guess, budget was one such event, in the last 4 to 5 months, government actually has got into the decision-making mode. And budget was one such event to really see, in terms of how the balance sheet of the government really looks like. So I think from a standpoint of, the statements and, the intent towards reducing deficits, I think the government has made it really clear that they would really look at reducing deficits, curtail expenditure as much as possible. And I think the good news was that there was nothing really as populist as people really thought that measures would be taken in this particular budget. So I think it was quite a serious budget. I think the risk off among the domestic investors for equities continues. It's been continuing for last 5 years. The only issue was that, would there be something, more to be done for Indian investors to come back to Indian equities. But I think from the investment allowance point of view, at some point you will see, corporates beginning to go ahead with capex. I think that's the time when, this particular element will come into play. The way it seems is that, government, regulators, all seem to be aware of the fact that we've now slowed down materially. And more importantly, inflation is also, on a trajectory downward. At some point, you would actually start seeing, the RBI also, coming into play and, reducing interest rates to nudge the economy further. Because any deceleration from here, could really take us nowhere. Because you have, low inflation, low growth, which is, I don't think really anyone likes it. So I think the bottoming out of the economy, how and when in the next, couple of quarters, I think that's the crucial point. I think the markets will be cognizant of the fact that, interest rates as they get cut, there would be impetus to growth. And I think that's something which the markets would tend to discount ahead of time. So I think there is a consensus getting built that second half of FY14 could actually get stronger in terms of economic growth. Right. And that could get priced in the next 3 to 6 months.
Mid and small cap stocks have corrected on an average by about 15 to 30%. So anything which is looking interesting from the mid or the small cap rec?
No, I think the small cap, there are a number of them where valuations are very attractive. The question is, and I think the markets are pricing in that if the slowdown continues for the next 2 quarters, will these earnings of small cap companies get hurt substantially? If you look at, I think after the correction in January, in the month of February, we have actually seen good amount of insider buying taking place from promoters of various small cap companies. So clearly telling you that the insiders are actually getting more positive, and the correction in valuations are far steeper and possibly not unwarranted in some of the cases. So I think from that standpoint, there is value surfacing within small cap companies. I think there are names galore in various sectors. I can't really speak about companies specifically, but I think clearly the valuations are positive. The question is that the risk off is so high and the under research is high. The reason to look at small caps, given the way the liquidity is, people don't tend to really take such risk. But clearly there is value surfacing amongst small cap names.
Historically, when there is blood on the street and when there is outright fear, it's a good time to buy into fear. Do you think at the current juncture it's good time to put money to work, or we could be staring at some more downside for blue chip stocks?
See, my sense is, after 2 months of a correction, especially in the broader markets, clearly I think while most of the people seem to be pessimistic, I think there is a rally in the short term coming up. And clearly there are various stocks. I think IT has been performing quite well. It could be technology stocks which will actually lead the upside. Clearly I think there are stocks like ITC where there could be pressure in the near term which could apply pressure on the Nifty as well. So I think it's a mix and match, but there are various companies to be looked at. But I'm not sure whether you can really extrapolate what happened in the last week to this week and assume that bearishness will continue. So my sense is that you will never get the bottom right, but I think clearly this is time to buy rather than to sell.
Shashank, so out of the 3 major markets, which market to your mind is really telling us the true picture. The equity market, which has broken down, the bond market where yields have gone up, or rupee market or the currency market where rupee is now at 55.
In fact, it's all together that you get the real picture. Clearly, I think the FIs have really paused on the buying side. On the current account deficit, I think everyone knows about the issues. So clearly there was pressure coming up. The moment FIIs eased out their buying, you're actually seeing rupee beginning to depreciate again. On the equity side, clearly there is pessimism, and very few people are hoping that the GDP can accelerate further. So clearly right now, in the last 1 month, we have discounted that there is deceleration, there is demand pickup is going to take some time. I think all of that has got priced into the equity markets. On the debt side, clearly I think the issues were that will government borrowing be higher than what has been projected in the budget? Are the revenue numbers which the government has projected optimistic? I think there were concerns around that, and hence the bond yield actually started to move up. So it's all put together that you really get a picture of where the economy is and how the investors are really looking at the markets. You really can't isolate one of them. So it's all together, and domestic or global, I think all these issues are getting factored into various markets, and all of them are traded quite actively.
Before we allow you to escape, give me a flavor of your portfolio. What are your current positions? What are you what do you own, and what are you planning to buy on every dip?
No, I think in the next 3 to 6 months, I think it could be a very interesting time to look at strong companies under stress because of slower growth. So it could be strong balance sheets where the demand is crumbling down, and that demand is going to be weak for a quarter or two, and there is a huge valuation sort of derating because of the slower growth. I think those are the companies to really bet on, because balance sheet companies with strong balance sheets can bounce back very quickly the moment you have demand conditions improving. So today, let's assume discretionary spending, be it autos, consumer durables, garment companies, they may be under stress, significantly, or even for that matter, real estate selectively. The demand conditions may remain weak, given the way the consumption tightness is right now. But it could be interesting that if the valuations correct, disproportionately in the next 3 to 4 months, it could be that these companies would be interesting companies to look at, especially when interest rate cuts actually start getting the demand back slowly and steadily. So I think acceleration in GDP, interest rate sensitives, and strong balance sheets with distressed sort of conditions because of slower earnings, because I think the markets are not in a mood to tolerate any degrowth in earnings. I think those are the companies which are getting punished severely, although be it a strong balance sheet. So I think those companies to be looked at in the next 3 to 6 months, they could be interesting plays on the way up.
Okay, Shashank, good having you on the show. Appreciate you taking the time out and joining us.